Welcome students. So after having talked about the cost of capital calculation with the help of CAPM in the previous class, now we will learn about the other three approaches, and the next approach is the calculating the cost of equity by using the bond yield plus risk premium approach, right? So in this process for calculating the cost of equity capital, we can use this method, that is this approach or this method basically called as yield on the long term bonds, or the you call it as the long term investments. So long term investment but in the form of the long term bonds. So yield on the long term bonds of the firm plus risk premium, that can be called as the cost of equity. So you can say that yield on the long term bonds, when we talk about, it's basically the risk free investment or the risk free rate of return, and on that risk free rate of return you can add some risk premium, and then you can calculate the cost of the equity. Because if you recall, when we were calculating the cost of equity by using CAPM, so first part of the model is RF, having the RF. So RF is basically the risk free rate of return, and for calculating the risk free rate of return, either we are taking the short term government securities or the long term government securities. So in this case we are also saying almost the same thing, that yield on the long term bonds of the firm, maybe of the same firm. I mean, the difference is there we are taking the government securities or the gilt-edged securities, but here we are taking the long-term bonds of the firm, and into that yield we want to add something which we called as the risk premium. So into the yield on the long-term bond of the firm, when we add the risk premium, that becomes the cost of the equity. So this is another approach. But here the challenge is that how much risk premium you can add or you would like to add while calculating the cost of the equity into the return from the long term bonds of the firm. So how much risk premium you want to add? Should it be 2%, 4%, or 6%, or n%, right? This is really very difficult, and there is no objective way of determining this risk premium. If there is any objective way of defining or adding up this risk premium, then there is no challenge at all. This can be equally useful or effective method maybe with the CAPM, but because CAPM is more scientific, because it uses more objective values or inputs to be used or maybe for taken into account for calculating the cost of equity. But in the bond yield plus risk premium approach, you have the bond yield which you are paying back to your investors, or that is the cost of your debt capital or the cost of debt capital to the firm, but the risk premium is not available, and there is no objective way of adding the risk premium. So for that purpose, this method is not widely used, but is not fully rejected also. Many firms use this, and in India, for example, you talk about the risk premium depending upon the financial and operating structure of the firms. We use the risk premium up to 2 to 6%, right? If the risk profile, operating and financial risk profile of the firm is low and is more stable business, if the firm is owning more stable business, then we will add 2% as the risk premium, or we can make it 3%, 4%, or 5%, but maximum is 6%. So for example, the yield we are paying on the bonds is, say for example, 7%, plus you are adding the risk premium as the 6%. So in that case, the cost of equity would be how much? 13%. So cost of equity is going to be 13%. So that way you can calculate the cost of equity. So this is another important way of calculating the cost of equity for a publicly held company. And only challenge, that is of a risk premium, then that can be done away by looking at the operating or the financial risk profile of the firm. Next model is the dividend growth model, right? Dividend growth model is another way of calculating the cost of the equity. And here again a challenge is that if the dividend per share grows at a constant rate of G, right, which is a challenge, right? So this is the, if the dividend per share of a firm grows at a constant rate of G%, right, then you can use the dividend growth model also. And in this case, say the first part of the model is something like this, that the say P0, the price of the stock is equal to D1 divided by RE minus G. So for out of this you can calculate the RE, means RE minus G, cost of equity minus growth rate, and if with this you divide the dividend in any say subsequent year, that gives us the value of the price of the share. So out of this model, you can easily calculate the cost of the equity because you have to calculate the cost of RE, the value of RE. So in this case, it becomes that D1 divided by P0 plus G. So in this case, you can say cost of equity is the dividend being paid on that stock in any say subsequent year and the price of the share in the current year or in the present periods. So dividend, proposed dividend in the next year and the price of the stock in the current year plus the G, that is the growth rate. So the expected return of equity shareholders is in equilibrium to the required return, and that is equal to the dividend yield plus the expected growth rate. Dividend yield plus the expected growth rate is going to be the outcome of this model, and that's going to be the cost of equity. So the cost of equity, you can say it basically, you can define it other way around, is that it is basically the rate of return required by the equity shareholders. RE, it is basically the rate of return expected by the equity shareholders. So you call it as a cost of capital, cost of equity capital, or rate of return expected by the equity shareholders, that is same, and that is equal to the dividend yield plus, dividend yield means in the subsequent year, plus the growth rate of that dividend, that is called as the cost of the equity. So it means, what is the dividend rate? If it is growing at a constant rate of G, so this is again a challenge here, that whether the dividend would remain stable, it will grow at a constant rate of G, or dividend in any subsequent year will be lesser than the present or the previous years. That can't be said very clearly, because normally dividend depends upon the profitability of the firm. So if the profits are high, dividend can also high. If the profits are low, dividend can also low. And if there is no profit, or maybe the low profit, there can be no dividend also. Or if for example, the reinvestment requirements of the firm are high, so firm cannot declare any dividend because they need the funds internally. So in that case, there is no dividend to be paid. For fulfilling the requirements of this model, you have to have a dividend payment for sure, and there has to be a constant growth rate of the dividend, means at the rate of G also. If these two conditions are fulfilled, then you can use this model. But the firms or the businesses who are not paying the dividend, even there are the profit, despite having sufficient amount of the profit, they are not paying the dividend sometimes because they need the funds to be invested internally. So in that case, you cannot use this model. So those firms, neither they are paying dividend nor the dividend is growing at the constant rate of G. So the model is not applicable. So for fulfilling this requirement of this model, for calculating the cost of the equity, you should have the dividend payment process in that company, and that should also be growing over a period of time, because the cost of equity capital under this model is basically equal to the dividend yield plus the expected growth rate. So if there is a dividend yield and that is growing at a constant rate, then you can use this model for calculating the cost of RE, or the cost of equity. But if the dividend is not being paid, or if it is not growing at a constant rate, you cannot use this model. But this one approach is there which you can keep in your mind. Last approach is earning price ratio approach, earning to price ratio approach, and according to this approach, the cost of equity is basically E1 divided by P0, right? E1 divided by P0, where E1 is the expected earnings per share for the next year. Expected earning per share for the next year, and P0 is basically the current market price per share. So in the subsequent year, how much earnings are expected and what is the current market price of the share is there. And for calculating the expected earnings per share for the next year, you can use, for this E1, for calculating E1, you can use this formula which says that current earnings per share into 1 plus growth rate of earnings per share. Current earnings per share means in the zero period, current earning per share into 1 plus growth rate of earnings per share. If you use this formula, you can easily find out the expected earnings per share on that particular stock for the next year. And if you divide those E1, that value of E1 by the P0, then certainly you can use this model and you can calculate the cost of equity by using this model of E1 divided by P0, which is basically earning to price approach. But it also has some limitations, right? This approach also has some cumbersome issues which are involved in this case, because it's clearly written that this approach provides an accurate measure of rate of return required by the equity investors in the following two cases, right? Only these two cases have to be fulfilled, these two conditions have to be fulfilled. only then the cost of equity calculated under earning to price approach will be correct. And what these two conditions are: when the earning per share are expected to remain constant, earning per share are expected to remain constant, and dividend payout ratio is 100%. So you can understand this condition is not very much practical. It's not very much feasible. You can say that number one, earnings per share is expected to be constant, that every year the company is earning the same rate of return per share. So the constancy of earning is required. And second thing is, whatever the earnings the company has, they are paying the dividend out of that. That is 100% of the company's earnings are being paid as a dividend, and no amount is being reinvested back into the business. So that's not practical, that's not feasible. And second condition is, when retained earnings are expected to earn a rate of return equal to the rate of return required by the equity investors. So that is also not very much feasible. That rate of means retained earnings of the company, when you are investing any part of the profit into the business, so those retained earnings are also earning the same rate of return as it is required by the equity shareholders. So if you look at these two conditions, they are rarely possible to be coming true. And it's clearly written here also that the first case is rarely encountered in the real life, and the second case is also somewhat unrealistic. Hence, the earnings to price ratio should not be used indiscriminately as a measure of the cost of equity capital. So because of these two limitations, when you look at these two limitations, that earnings of the company are expected to remain constant, they cannot change. And second thing is, dividend payout ratio is 100%, that cannot be possible. Second thing, if retained earnings are there and if they are invested into the business, they should be earning the return equal to the rate of return required by the equity shareholders. So both the conditions are almost unrealistic, non-feasible. So this approach also cannot be indiscriminately used to calculate the cost of equity. We can use it as a supplementary measure. If these two conditions are fulfilled, or maybe part of these two conditions are fulfilled, then only we can use this approach as a supplementary measure, but you cannot use it only measure for calculating the cost of the equity, because the requirements are very stringent and unrealistic. So for that purpose, you have to depend upon other approaches for calculating the cost of the equity. And as I told you earlier also, that most widely used method for calculating the cost of equity is the capital asset pricing model, because other methods have one or the other limitations, and the information required for say calculating the cost of equity using the other methods is not easily available, not objectively available, I can say. And if any amount of the subjectivity you involve in calculating the cost of equity for any company or for any project, in that case the real cost of equity cannot be expected to be worked out. So largely used method is the capital asset pricing model. Other three methods are used as a supplementary methods or supplementary measures, only to verify that how far we are correct when we are calculating the cost of equity by using CAPM or capital asset pricing model. So now the question can be, $1,000,000 question which may come in your mind at this stage is that when we are discussing the project finance or the project management as a whole, why we are talking about a public limited company? Because in the normal course, when a venture is set up, maybe by a group of new entrepreneurs or the fresh entrepreneurs, maybe in the form of a startup or an existing company also, but it rarely happens that a new venture is set up by an existing company, and that too in the form of a public limited company. Initially, every venture starts at a low level or at a small level. If it is by the new entrepreneurs, it can be a sole proprietorship, it can be a partnership firm, or it can be a privately held company. And if either of the three forms are used to set up a venture, then I think there is no question of calculating the cost of equity by using any of these four methods. Neither their CAPM is applicable, nor the dividend growth model is applicable, nor the earning to price ratio model is applicable, nor the bond yield plus risk premium approach is applicable. So why we are discussing these approaches here? What is the say fun of, or what is the justification of discussing these approaches which are not applicable to the ventures, to the projects who are not the public limited companies or who are not publicly held companies? If any venture, if any project is set up as a sole proprietorship, what will happen? as a partnership firm, what will happen, as a privately held company, what will happen, and how we will calculate the cost of equity or maybe the cost of investment made by the owners of those kind of the businesses. And normally maybe 90% of the businesses are set up initially sole proprietorships or partnership firms or the private limited company. So what is the use of discussing all these methods of calculating the cost of equity? So the justification here is that always every entrepreneur thinks and should think also that maybe he is starting it as a sole proprietorship, right? But very quickly I want to convert or take it up to the transnational level. For example, you talk about the Jeff Bezos. When Jeff Bezos started working in a garage, he started selling the books online initially, right? It was a sole proprietorship. His investment was also very limited and his level of operations was also locally spread, and he himself must not have thought about that in a short span of about 30 years. In a short span of about 30 years, Amazon will become a transnational existence, transnational entity, transnational venture. Today, in the e-commerce segment, hardly there is any company which can compete Amazon. In India, every nook and corner of India, Amazon exists. So you can understand the spectacular growth of a company or a venture or a project like Amazon, which in a short span of 30 years, in 30 years, I think people cannot even think of. If you talk about the Nirma story, which we call it as a very spectacular, and it is. It's a very, you can call it as a good company, good idea, good establishment, good product and a good business strategy, which started working from early or mid 60s, and even today also, their business is not comparable to the business of Amazon, right? So it can happen that, for example, if you are moving in the right direction, you are adopting the right business strategies and you are into the right business sectors of the product or service, then there is no reason that your company or venture cannot become another Amazon or a transnational company in a short span of 20-30 years. So if you want to take your company from the sole proprietorship or your project from the sole proprietorship to a transnational company like Jeff Bezos, certainly you would be requiring all these methods. So you should have all these notions in your mind right from the day one, that though today I am starting this small business with the say 10 lakh rupees coming from my pocket as say sole proprietorship, but I will grow at a very faster rate. Soon I will convert it into a private limited company, and very soon I will make it as a public limited company, and I would make another Amazon on this earth, and in a short span of 25 to 30 years it will become a multinational existence. So if you start with this notion in your mind or with this kind of the mindset, then you will grow at a very faster rate and all these methods will become very useful to you. But if you think that you are going to stay as a sole proprietorship firm for the next 10 years, then as a partnership firm for the next 10-15 years, and then you will work as a private limited company for another 10-15 years, so it means for the next 50 years you cannot think of converting your sole proprietorship into the say public limited company. So you should not talk about calculating the cost of equity by using the CAPM or this other 3-4 approaches, right? So your approach should be that all these methods are important to me, and very soon I am going to come out with my IPO and I will convert my privately held business into publicly held business, and my project, my venture is shortly going to be a public limited company in India, and in a short span of time I will be making it as a multinational company. We will have a multinational presence, multinational existence, and I'll make it as a multinational or a transnational company in a span of next 30 years. So with that approach, if you are going to set up a business or project, then you are going to grow at a faster pace, and all these methods are going to be useful to you. But if you are thinking that no, you will grow at a very slow, snail's pace, then I think all these methods may not be useful to you. Then you should not be talking about calculating the cost of equity by using CAPM or maybe the other out of these 3 other approaches, right? So always think, be optimistic, grow at a faster pace, and set up a venture which grows at a faster pace and become another Amazon on this earth in a short span of about 30 years. Now, determining the proportion of the weights. After having talked about the different methods of calculating the cost of capital, all three sources, debt capital, preference capital and equity capital, now our next job is to learn about that how to determine the proportions or weights for calculating the something which we call it as the weighted average cost of capital, because ultimately when you are going to use the capital from the multiple sources, so in that case you are going to use this process, and you have to encounter this question of determining the proportions or weights to the different sources from where the total capital would be coming to your venture. So the answer is that the appropriate weights are the target capital structure weights stated in the market value terms. So target capital structure, maybe there can be two things. Already this is a firm existing and this new project you want to set up. So you have existing capital structure for this firm A, right? Now you want to set up a new venture and this is B. This is owned by the firm A as well. So it already has a capital structure. Firm A has a capital structure, but you want to set up now another new project to be owned by the firm A itself. So what should be the capital structure, or how would you be determining the weights to the different sources of the funds? So would you be using the present capital structure of the firm A, or you would be using the target capital structure which you propose for the firm B or the new project or the project B? So normally it is written here that it should be the target capital structure which is going to help us to determine the weights or the proportions, and they should be decided or should be read in the market value terms, not in the book value terms, right? So what is the target capital structure and what is the market value of those different sources, that is the debt capital, preference capital and equity capital? On the basis of that target capital structure which is defined in the market value, you should define the weights or you should determine the proportions. The primary reason for using the target capital structure is that the current capital structure may not reflect the capital structure of the expected firm in the future or expected in the future. So current capital structure is different. For example, in the current capital structure, your say equity component is more, debt component is less, or maybe debt component is more, equity component is less, and you have seen the limitations of this existing capital structure. So if the new capital structure also you define in the same way as the old one is, then it might also carry the limitations of the existing structure from the existing firm to the new firm. So you decide a fresh, maybe a new capital structure, and then you can say that initially I will make investment as a proposer. I will make, or we will make investment largely from our own sources. We will start at a small level. So more funds will come from the internal sources. Our borrowings will also be very less. And then if we grow, if we become successful, grow over a period of time, then we will think about that how much profits we earn. In same proportion, we will make reinvestment of that profit back into the business, and still if the need is required, we will borrow the funds from the market. So as per the target capital structure, how much you are investing in the form of equity, how much you want to reinvest the part of your profits back into the business, and how much you want to borrow from the market, accordingly you can decide the proportions or the weights. Not miss in a stereotype manner that in our existing business we are having this kind of the capital structure, so we will have the same capital structure in the new projects also. No, always use the target capital structure, expected value capital structure. You decide how much funds will come from which source, internal as well as the external sources. And when we say in the market value terms, initially book value and the market value will be same. When you are talking about the beginning, the market value and book value will be same. But later on, for example, the market value is more than the book value. So you have to say that my capital structure means, if you have to interpret it tomorrow, you have to use the expected or target capital structure, that too in the market value terms, because that will help you to calculate the true value of your business also. So determination of the proportions or weights will be based upon the target or expected capital structure, and that too in the market value terms. And finally, we can say that for calculating the weighted average cost of capital, we can use this model, right? It's a simple model you must have seen many a times. So we are taking into account the proportion of equity capital and cost of equity capital, proportions of the preference capital and cost of preference capital, or W means weight. and the weight of the debt capital and the say cost of the debt capital. And this debt capital has to be after deducting the tax. We will have to take into consideration the pre-cost of the debt and to be adjusted against the tax rate, corporate tax rate. So that way the weighted average cost of capital would be decided. So you have all the proportion. You have the proportion of equity, cost of equity, proportion of the preference capital, cost of preference capital, and proportion of debt and the post-tax cost of the debt. So you have to take all these three sources and finally you have to sum it up. So it will become the weighted average cost of capital, which can be seen here with the help of these small calculations. So source of capital is, for example, debt, preference capital and equity capital. So 60% in this firm, for example, is coming from debt, 5% is coming from preference capital and 35% is coming from the equity capital, right? So the cost is 16% for the debt, 14% for the preference capital and 8.4% for the equity. So finally weighted cost becomes 9.6%, 0.70%, 2.94%, and weighted average cost of capital is going to be 13.24%, right? So weighted average cost of capital is going to be 13.24%. So it's very simple process. We are going to have the capital from different sources, and finally maybe which one is going to be the most suitable and sustainable for the firm, that source is going to be used to the fullest possible extent. Ultimate purpose deciding a balanced capital structure or maybe defining a balanced capital structure is that the overall cost of capital is under control and is comparable to the required rate of return. If you decide a capital structure where the cost of capital is very high and sometime it goes up or goes beyond the expected rate of return, so your project becomes infeasible and you cannot go ahead with this kind of the investment options or the investment avenues, because ultimately the net present value will become negative. So we don't do that. So anyhow, we have to look at the cash flows also, we have to look at the discount rate also, and we have to define a capital structure which gives the sustainability to the business also, which keeps the cost of capital controlled, totally controlled also. And when we discount the given cash flows or expected cash flows with the expected cost of capital as a discount rate, NPV becomes zero at a very faster pace, and then it starts giving us the positive value, positive NPV, and finally the venture becomes a profit making venture or maybe a surplus value generating venture. Point of caution here is that sometimes people think that debt is cheaper than equity, so we should bring more amount of the funds in the form of the debt in the capital structure. For example, in this capital structure also 60% of the funds are proposed to be brought in the form of the debt, and remaining 40% are proposed to be brought in the form of equity. So debt equity ratio largely is going to be 60-40. You have to be very careful here. We all understand that debt is cheaper than equity, but when you bring more amount of the funds in the form of the debt in the firm, it brings more distress also, right? It makes the firm more distress full, and larger the amount of the distress in the firm when you are raising the say fixed liabilities on the overall financial structure of the firm as well as on the operating structure of the firm. Sometimes even better performing businesses also become sick over time, and maybe it can lead the business or the project towards the failure. So be careful that initially don't bring more amount of the funds in the form of debt while deciding the proportions or weights. Try to bring more amount of the funds in the form of equity, largely from your pocket or from the other sources, but that too in the form of equity. Debt component has to be as low as possible. If you do that, maybe the cost of equity little can go up, but the firm would be more safer. It will not be under distress at all because it's not raising the funds from the fixed liabilities, and you would be at liberty, right, at flexibility, that if there is income, you can share that income with the owners. If there is no income, you can not share, you are not under any obligation to share that income with the owners. And if there is a less income, you are not supposed or not required to pay any dividend to the owners. Rather, you can make the whole, means the profit can be reinvested back into the business. So be careful that for the sake of reducing this weighted average cost of capital, never bring higher amount of the funds, more amount of the funds in the form of debt, because new ventures are not able to sustain the high amount of the debt, and that may create a serious problem. So larger amount of the fund should come in the form of the equity, and accordingly you should manage the weighted average cost of capital and discount rate for discounting the cash flows. So, with this discussion, we will stop here for the now, and the subsequent discussion, some more relevant discussion with regard to the flotation cost or deciding the optimal capital structure for any firm, taking into consideration the rate of return and cost of capital. All these, some more I can say more relevant concepts with regard to the cost of capital, we will discuss in the next class. Till then, thank you very much.